Welcome back to All About Economics. Last episode, we learned what a single call or put is. Today, we combine them into strategies, the spreads that professional traders actually use. On their own, options are blunt instruments. But by buying one and selling another at the same time, you can shape your risk and reward with surgical precision, cap your costs, define your maximum loss, and bet on direction more cheaply. We will build the two classic spreads, the bull call spread and the bear put spread, decode a trade that looks like a total contradiction, and then play detective on a professional exam puzzle to find the one fatal flaw. Let us learn to combine options. Section 1. Why combine options? A single option is a one-dimensional bet. Buy a call and you pay the full premium, with profit that can run far, but a cost that stings. The insight behind every option strategy is this. By simultaneously buying one option and selling another, the premium you collect from the one you sell helps pay for the one you buy. You give up something, usually some of your potential profit, in exchange for a lower cost and a clearly defined risk. This is the art of the spread. You are no longer making a raw, open-ended bet. You are sculpting a precise payoff, choosing exactly how much you can win and how much you can lose before you ever place the trade. Section 2. The bull call spread. The first classic strategy is the bull call spread. For when you are moderately bullish, you expect a stock to rise, but not to the moon. You buy a call option at a lower strike price, giving you the upside, and at the same time you sell a call option at a higher strike price, collecting a premium that offsets your cost. So if the stock is at 50, you might buy a call with a 50 strike and sell a call with a 60 strike. The sold call brings in cash, making the whole position much cheaper than buying the call alone. You have built a bullish bet on the cheap. With a clear structure, you profit as the stock rises, but only up to a point. Section 3. The trade-off. Why would you sell away part of your own upside? Because of the trade-off at the heart of every spread, cheaper entry and defined risk in exchange for capped profit. In the bull call spread, your gains grow as the stock climbs, but only until it reaches the higher strike, the one you sold. Above that level, every extra gain on the call you own is exactly canceled by a loss on the call you sold. So your profit is capped. In return, you paid far less to enter, and your maximum loss is limited to that small net cost. You have traded unlimited, expensive upside for affordable, capped upside, a smart bargain when you expect a moderate move, not a miracle. Section 4. The bear put spread. Now the mirror image for when you are bearish. The bear put spread lets you bet that a stock will fall, but without the open-ended cost of buying a put outright. You buy a put at a higher strike, which gains as the stock drops, and you sell a put at a lower strike, collecting premium to cheapen the trade. Just like its bullish cousin, this caps both ends. Your profit grows as the stock falls, but only down to the lower strike you sold, beyond which it is capped. And your maximum loss is just the small net premium you paid. It is the go-to way for traders to bet against a stock with limited, fully defined risk, no nasty surprises, no unlimited downside. Section 5. Defined risk is the point. Here is the deep reason professionals love spreads, defined risk. With a naked option position, your potential loss can be frightening, and a sold option alone can expose you to enormous danger. A spread boxes everything in. Before you place the trade, you know your maximum possible profit, your maximum possible loss, and the break-even price. All three, with certainty. That transforms options from a wild gamble into a calculated, risk-managed position. You are never blindsided, because you computed every outcome in advance. This is the difference between a professional, who always knows their worst case, and a gambler, who finds out the hard way. The whole craft of option strategy is engineering a payoff you fully understand. This discipline is exactly what an exam, or a real trading desk, will test you on, because anyone can buy an option on a hunch, but only a professional can state, to the shekel, what happens in every single scenario before risking a cent. Section 6. The contradiction trade. Let us decode a real trade that looks bizarre. A trader bought 5 call options at a 12 shekel strike, betting the stock rises, but at the same time sold 10 call options at a 15 shekel strike, which profits if the stock stays down. Buying bullish and selling bearish at once, what on earth? This is a spread, a structured view that the stock will rise, but only modestly, toward 15, not far beyond. The bought calls capture the rise to 15, the sold calls finance the trade and cap the gains above it. It only looks like a contradiction if you think of each leg alone. Seen as one position, it is a precise, low-cost bet on a specific, moderate move, exactly the kind of nuanced view a single option cannot express. Section 7. Find the flaw. Now the detective work, straight from a professional trader's exam. You are given a complex option strategy and 4 statements about it. The maximum loss is 100, the maximum profit is such and such, the break-even is here, and so on. 3 statements are true, but 1 is a lie, and your job is to find it. In the real world, this is not a game, because that one wrong number could be the difference between a tidy profit and a catastrophic loss. The only way to catch the flaw is to do the work yourself. Map out the payoff at every price. Compute the true maximum profit, maximum loss, and break-even, and compare them against each claim. The false statement reveals itself the moment your own numbers disagree with it. Section 8. The lesson: know your numbers. So the master lesson of option strategy is simple but absolute. Always know your numbers before you trade. For any spread, you can and must compute 3 things in advance: your maximum profit, your maximum loss, and your break-even price. These are not estimates. They are exact, determined entirely by the strikes and premiums you chose. A professional never enters a position without them, because they refuse to be surprised. Spreads are powerful precisely because they make this possible. Every outcome is knowable beforehand. Master the arithmetic of a few core spreads, and you hold a toolkit for expressing almost any market view, bullish, bearish, or neutral, with your risk always defined and never running away from you. Conclusion: we have learned to combine options into real strategies. The secret of every spread is to buy one option and sell another, trading away some profit for a cheaper entry and a defined risk. The bull call spread is a low-cost bet on a moderate rise. The bear put spread a limited risk bet on a fall, and even a trade that looks like a contradiction is just a precise view on a specific move. Above all, spreads let you know your maximum profit, maximum loss, and break even before you ever trade, which is what separates the professional from the gambler. Next, we put the whole finance track to the test with a set of worked exam problems. If this leveled up your options game, please subscribe to All About Economics and share it. See you in the finale.